Thanks for taking time out of your busy schedule today to speak with me on behalf of Sarwa. I just want to get into some historic background and also a bit of the philosophy of Vanguard. I know that in the 1970s, Vanguard created the first passively managed index fund. So let's talk about Vanguard's particular product philosophy, especially how it's focused on providing low-cost, high-quality building block type funds, which investors can, put together broadly for the long term. This is actually in tune with our personal philosophy and many other robo-advisors. So elaborate first on that philosophy and how it stems back to Vanguard being the pioneer in passively managed funds.
Yeah, so it sounds like, you're obviously familiar with the company, and in a way, the growth.
I've had some help from Jonathan. Yeah.
Excellent. Well, I think the thing is, ETFs have grown out of this secular move to indexing, and so we can't view ETFs just on their own. They're part of an overall shift to indexing, and Vanguard has been, in on the ground floor, if you like, from the mid 70s when Bogle first started on this journey of the idea of indexed funds. They were seen as a bit of an oddity and something that people couldn't really understand, or maybe were too sort of academic, and quite frankly, they didn't seem exciting enough, against the world of active management. And so the journey for Vanguard goes right back to those early days of creating some of the earliest index vehicles. But the academic sort of background to this goes back decades. And I think sometimes you see that with financial services, is you have the academic theory and the research, and then over time, you have the experimentation with new products, and then you get the regulation of those products and the adoption more generally, if they're to be successful. And so the index world has grown steadily, slowly at first in the 70s and the early 80s, but then over time, I think, as you would have seen, investors seeing the performance track record of these products, there's been a growing greater awareness that actually active management is very, very difficult, and outperforming a given benchmark over time after costs is incredibly difficult. And it's not only difficult for a fund manager to achieve or an investor to achieve, it's really difficult for other investors to find the managers that can do it, and obviously find them in advance of them going on a good performance run. And so you've then got a confluence of lots of other events. So if you think about the early 80s and the 70s, inflation was much higher, interest rates were much higher, technology wasn't as good. There wasn't the ease of access to data and the ability to crunch, the data these days. And it's very, very cost effective now, the technology, to bring in millions of bits of data points. And so there's a lot more tools in the hands of your kind of average investor. And if you think what's happened over the sort of the 80s, the 90s, and into the 2000s, inflation and interest rates have steadily fallen. Yield and income on securities has become historically sort of suppressed, and so it's difficult to find these returns. And all along that way, Vanguard was preaching the other side of this coin, which is, hey, don't pay too much because costs destroy your returns. And you can see that as the index sort of world has grown, and ETFs have grown as part of that, particularly over the last 20 years, this idea of, well, I'm going to compare the active managers to these index benchmarks and these products, and then I'm going to have a look at the exposures that I can get access to. And lo and behold, the price of indexing is so much lower on average than active management that active management has a very high bar, because it has to take enough risk to get back the costs that it's charging firstly. So
absolutely, yeah,
you've had all these things together, and Vanguard's just been part of that story that sort of takes us on this journey to where we've got to now.
And you said this was also based on decades of academic studies and research that was already there, and in that way we're standing on the soldiers of these academics. And I think one of them might be the modern portfolio theory. Obviously, Warren Buffett is a big proponent of passive investing. What other academic philosophies do you follow at Vanguard?
Well, I'll leave, say, Jonathan to maybe supply some sort of names perhaps afterwards. But I mean, if you think of just actually Bogle himself, his thesis that he wrote, I think in the 1950s around this, and the idea that, like you say, modern portfolio theory, that it's actually really very difficult to, if you look at your risk return, to generate sufficient return after costs, and that's the critical thing. What's happened is you've now got access to data and information on a level that was unimaginable in the 50s and 60s, where it was a lot simpler to be an active manager. For a start, even the regulations have changed. Insider trading was perfectly legal in the 50s and 60s and 70s. So therefore, it's a bit easier if you know that people also don't have the data to hand to check what you're doing, to find alpha. But now you've literally got millions of investors, and we've all got this great technology on our smartphones. We can call up the share price of a stock, in seconds. We don't need to phone someone up and ask them or check the newspaper. So you've got all this sort of movement as technology has shone a light on these activities. But the other thing to remember is the development of benchmarks. Again, it's something that's not often fully understood. The S&P 500, as we know it now, developed in the 50s and then developed again a bit further, reconstitution in the 70s. But as the technology's got better to capture stock data, you can now create benchmarks with thousands of securities. Whereas if you go back to pre-computerization, it would have been people doing that with pen and paper and with tables and physical bits of paper. So the benchmarks were created to check the performance of the active managers. It's just then sometime after the development of benchmarks that products have come along that can track those benchmarks and that enable you to compile a portfolio. And this is what the ETF comes in. If you think about it, it's one trade. You place one trade, and in doing so, you gain exposure to thousands of securities in an incredibly cost-effective way. I mean, it's almost unheard of. Whereas you go back to sort of the idea of high conviction active managers who were using data that, as I say, might nowadays be classed as inside information, and the person on the street only really had their newspaper to get stock prices and fund prices. Well, there's an information advantage there, isn't there? Whereas nowadays, it's much more difficult to have that information advantage.
But for the first 15 years of the ETF's inception, since its inception, it wasn't that popular. Like you said, it was too wonkish. Maybe it wasn't sexy enough for people who were looking for the active trade, right? But the global recession in 2008 changed that. There was a spike from being, I think, a global value of, off the top of my head, about $700 million to now 6.36 trillion by the last number I have in 2019. To what does Vanguard attribute such a dramatic rise in the ETF's popularity and success? And how are you adapting to this very dramatically, rapidly shifting market, especially considering the complex background of 2020?
Yeah, I think it's very interesting to look at the financial crisis, actually, because that's the last big market downturn that we had globally. Obviously, we've had the one recently, but the last big one was 2008. And a lot of clients and investors, institutional investors, looked at the performance of their funds and said, well, hold on a minute. I'm paying these active managers to protect me in a downturn as much as provide me alpha in an upturn. And that didn't happen. And the performance figures are there. Now, one example of this is the large Norwegian sovereign wealth fund who conducted a study, Andrew Ang, and I forget the other two guys who were part of that, to look at and analyze what was driving stock returns. And from this came the idea of factor investing and, a greater questioning of what are active managers actually doing? What are they delivering for their fee? And you will frequently hear this, and we heard it last year actually a lot. As equity markets rose, there was a lot of active managers saying, "Oh well, in a downturn, we'll be able to outperform because we can stock pick and we can move into cash." Well, unfortunately, that just because they can do something in terms of they have the option doesn't mean to say they're actually able to execute it and generate alpha. And what happened after the GFC, the global financial crisis, is a lot of investors looked at their performance and said, well, I'm better off shifting at least a part of my allocation to beta, cheap market beta, because then I can spread my risk because I can put it across hundreds or thousands of securities. It's very, very cost effective. And in actual fact, active managers consistently prove that they're unable en masse to generate alpha after costs, after the long term. It's so difficult to market time and to select securities. And so you saw a huge uptick in flows into indexing. And again, ETFs were part of that from 2008. And then, of course, we just went on a very long bull run effectively up until recently. But I guess one other thing to think about is initially, like to your comment, ETFs were they're used by sophisticated investors. They were used by institutions and fund managers. But the beauty of an ETF is it's democratic. So if you and I, if we buy product, we pay the same price as a sovereign wealth fund. There's no other share class. There's no hidden pricing. The cost is the cost. And so as institutions and professional managers have adopted more and more usage of ETFs, that's created competition and demand. That's brought down prices, and that's been great for the end investor, whether they're an advisor or an actual retail investor, because that competition and that growth and adoption has created a ton of choice and price compression. And so we can now go and benefit from that by buying this product at the same cost. Like we can spend, $10,000 and we'll pay the same amount as someone who puts $500 million in. So it's very democratic.
Absolutely.
I struggle to think of another financial instrument that is as democratic.
I think you're on the correct wavelength with that. And by being so democratic, the ETFs have also been part and parcel of this new wave of millennial young investors that have jumped on the bandwagon, partly through easy applications like Robinhood as well, to really become traders during the pandemic. Have you noticed an uptick in interest during the lockdowns?
Well, Jonathan can provide you with some numbers for our retail business, because we have a growing business here in the UK, and we have a large mature business in the States. So we have around 30 million customers or clients. Okay. And so what you can see there is their buying behavior, actually, those that invest with Vanguard, is very disciplined. And if anything, we've seen investors, they're not over trading. They may well have opened accounts or increased their allocation when markets were down. We didn't see them sort of panic and try to move all their cash out, which you could argue we did see in the institutional market.
Yeah, of course.
So we've actually had very disciplined investors who are thinking about the long term, and they might be buying in when the market's down a little bit, but it's still on the basis of a long-term investment. Now, you're absolutely right that if you look at the States in particular, where people are much more familiar with say day trading and just trading stocks and securities generally, the market is quite different from, say, Europe and other parts of the world. There has been additional activity, at least anecdotally. We've just not seen that within our own investment base. We've actually seen very disciplined investing. But you are onto something with millennials, and the younger investor seem much more comfortable when you look at the buying patterns with ETFs. And I think they just maybe buy into this idea that they're the new technology and they're easy and quick and flexible, and they lend themselves to robo-advisors, as you say.
Yeah, and that's part of our story as well in Dubai. And it's not just the millennials, of course. There's also, the old guard, the predominantly active managed funds that are now getting into the ETFs. This includes pension plans, insurers, who are increasingly, according to a recent Bloomberg study, using ETFs as the low-cost core of their portfolios. Have you seen any type of shifts from the old guard into your philosophy to become more in tune with Vanguard over the past years?
Yeah, I think we would say it's very difficult to know precisely who buys ETFs with any real detail because they're exchange traded. But certainly, if you believe the surveys and from what we see, institutions do benefit from the flexibility of ETFs. So we have conversations around core holdings, to your point, where there can be core, buy and hold long term, because these are very, as I say, very cost effective, and they're a great way equally to rebalance as well, because if it's particularly when markets are moving around, it's the quick, easy nature of the trading and the exposure, that secondary market liquidity that you get with an ETF, that means you can adjust and tweak your positions very, very simply. The other thing you mentioned, pension funds, is they can use ETFs for transitions. So let's just say they're moving between managers or they're adjusting asset allocation. Well, actually, rather than them going off and selling down a fund and going into cash and then buying into another fund, or potentially sitting in cash, or shifting actual direct holdings, the ETFs can allow you to take those exposures really quickly and easily, and then you can fine tune them very simply as well, because it's just so easy to trade. Particularly, I think you'll see greater adoption on the fixed income side, because for a lot of institutions, do they want to go down the route of having their own internal teams conducting all the due diligence and trying to get pricing on hundreds of direct bonds, or can they allow an asset manager to do that and get the exposure in one trade?
Right on. I actually think it's important to touch upon the fact that there are actively managed ETFs as well as passively managed ETFs, although the latter is much more representative of the investment class. Can you talk a little bit about how you perceive actively managed ETFs at Vanguard, although understanding that it is not exactly in tune with the philosophy we've just discussed?
Yeah, I think you're going to see a growing kind of development there, especially as some regulatory changes. But if we look at the ETF GI numbers, the latest I've got, they're showing around $170 billion in active ETFs globally. Now that's against a total, as you said earlier, of north of, say, $6 trillion globally. Yes. So you can see it's a small part, but it is growing. It was maybe 100 billion last year, so it's growing. I think as ETFs just generally continue to become adopted more broadly, you're going to see people put different strategies into them, and as some of the regulations change and maybe allow that a bit more easily, I think it's natural you'll see some more choices there. Now we actually we have some factor products. Now they are actually in ETF form, and they're active. So our factor products don't track a benchmark. We actually use our internal portfolio managers to build the portfolios. And so I think you'll find that there will be similar quant type strategies in some of these active funds. Where I have difficulty is, imagine that you're a high conviction sort of fund manager, you're a stock picker, you've got maybe a handful of securities that you've done your analysis on, maybe 30 or 40 in your portfolio. Do you really want to put that in an ETF? Because you're going to have to share the holdings with the broking community so that they can make a market in it. Now, if you're that type of manager, you probably don't want to give away your kind of secret sauce and divulge your trading and your holding. So that's where I know some structures are starting to be developed that will allow that type of process to take place. I just wonder if it's necessarily appropriate for that type of investment to be in an ETF, because the other thing to remember is an ETF is an open-ended fund, so it needs to have
transparent as well.
It's got to be transparent. It needs to be priced easily and quickly, but
Right.
They're typically scalable. And the one thing that we find with active management is because we have a large actually active fund business in the States, well over $1 trillion. And the key thing when you do find a good active manager is you need to preserve their alpha capacity. So you want to be able to gate the fund, just, and soft close it because you don't want them being too popular and then not unable to deploy their strategy. Now that can be done in a fund. It's much more difficult if you put that into an ETF, because again, how do you control the flows in and out? And so I think you will see more use of the active approach. I think we will see more growth there. You'll see more kind of experimentation and innovation from not from us necessarily, but from other parts of the market. But so I suspect we'll see growth there, but it doesn't follow that every strategy, I think, nicely fits into an ETF mechanism.
No, it doesn't, and I see what you say, but there is certainly a popularity in there, and I think that it was important to just give a nice overview of that.
Yeah.
That being said, it's true that ETFs are not for everyone. They come with plenty of naysayers that even claim that this could be the next bubble. But there is still scant information that I have found supporting this theory. What are the main cons of ETFs, in your opinion, and how do the positives potentially outweigh them?
Well, I think one of the cons, and it's something that's common against all financial instruments, is when something becomes popular, it attracts a lot of people into the space in terms of offering products. It doesn't follow that all of those products are suitable for an ETF. So what I mean by that is an ETF is exchange traded, which means in theory anyone can buy it. Now, if you go ahead and create a very complex, say, leveraged ETF, and it's tradable, now you might not intend it to be bought by anyone other than the very sophisticated investor you have in mind. It's very difficult to stop someone with a brokerage account buying that product. And so I think some of the newer niche, more experimental sort of types of strategies, they perhaps do bring with them a risk that they're complex and they maybe are difficult to understand for an average investor. And they're probably not what an average investor actually needs. Whereas, fortunately, the bulk of ETFs and the bulk of the AUM by far sits in the ones that we sort of started the conversation on, which are the broad, liquid, diversified, transparent structures and transparent exposures. And I think if there is a risk, it's that, there are niche products that gather a lot of press, maybe if they don't do so well, like some of the leverage ones. Or as we saw with some of the commodity products in the States recently, where they really struggled with the movement of the oil price, and you saw, negative futures contracts. That type of thing is very difficult to explain to investors who are not very, very sophisticated. And so there's potentially some risk there, I guess, because you can't control who they get distributed to. Now we don't. That's not us. We're very much core, long-term buy and hold. We want things to be transparent and straightforward.
Right on. So you're saying that there is a risk that if an ETF, a particular ETF, gets the right type of news coverage, it could become a victim of its own success because you have a herd mentality that rushes into it, for example. Something like this.
Yeah, I guess, and it's like everything. It's buyer beware. You've got to do your due diligence, and just because something has been created, it doesn't mean to say that it should attract all types of investors, and so that might be the only risk. But I guess that is a risk that comes with any popular investment.
Absolutely.
Not everyone is capable of riding a super bike, or not everyone's capable of driving a 200-mile-an-hour sports car. So you have to fit the object to the occasion. Understood.
And you mentioned something important right there, due diligence, and that ties into one of the great pros of ETFs is that transparency, and that really differentiates it from, say, other, say mutual funds, etc. How how do you prioritize due diligence and Vanguard, and how do you think that the fact that ETFs are so transparent have helped them become popular vis-a-vis, say, other less transparent funds?
Yeah, I mean, for us, the main thing is we think very carefully about the core enduring products. So that's why we don't have a huge proliferation of products. We're looking for to provide the building blocks that enable people to build a global portfolio that is a mixture of bonds and equities and different countries and regions. We don't go too granular. We just provide those long-term core building blocks. Now, if someone is prepared to take more risk and has slightly different objectives, then it may be that other products are more suitable for what they're trying to do. But that's our philosophy. And then we work with highly respected index providers, and we understand their methodology. They again need to be published and transparent and liquid, and that's how we'll think about our product development. And crucially, we don't want to create products that are trying to be faddish or trying to time markets or follow a niche. These need to be the ones that form the core of your portfolio over decades.
Absolutely. Okay, that's understood. That brings me to the conclusion of this. Let's wrap it up by giving a long-term perspective of the ETF market going forward. How do you see it developing? We can take it from a long-term perspective, since that's so clearly what Vanguard's philosophy is. And do you see potential for interesting innovation that Vanguard is looking at now that you could possibly release to me?
Well, I think we'll see greater retail adoption. Essentially, I think the idea of the robo-advisors, the more flexible, automated, cost-effective, cost-efficient method of delivering exposures quickly and easily, and in a way that's easy to digest and understand, ETFs are the perfect components for that. And there's still, bearing in mind, the majority of assets globally still sit in active strategies and are still very costly. We think there's work to be done to shine a light on this, and that there are a great many investors out there who are not aware or are not fully aware of the benefits of ETFs and indexing. So there's a lot of work to do there. But that means also the growth trajectory is really quite large, because the bulk of investments still sit in active management. And that's your opportunity set, if you like. In terms of development, ESG is something that's coming up all the time. I think the market is still trying to work out, what that's going to look like. There's a lot of regulatory changes over time. We've got the Paris Climate Accord. So I think there will be innovation there, because the world has to address that side of things. I think also we'll see continued growth in the fixed income side, because the ETF story has been led really by equities over the last sort of 15 of the last 20 years. I think we'll see more adoption of fixed income. So it's really, I suspect, fixed income and ESG is going to be sort of an area of growth.
Absolutely. And just to conclude on that point, this whole idea of there being such a great market to tap out there, that is the exact point of why we're doing this interview. And I thank you for your time to help not only educate my audience, but myself as well.